Hello, everybody. Welcome to the Lowdown. I'm Michael Smith, and joining me today is Kevin Lenox, and back on the show. So, Kevin, a lot's happened since you last were on here, and we've gotten through Q1 earnings or quarter one earnings. Well, how did we do, and what is this telling us about what's happening going forward?
So we're just getting started.
Mm-hmm.
The expectation for the quarter is about 2% year-over-year gain and about 8% for all of 2024.
Okay.
So a little better path than we've been on. But what's most interesting is that the top 10 largest companies are expected to deliver earnings this quarter of 32% above
Wow.
last year. Guess what the bottom 490 are?
Let me guess.
Minus 4%.
Wow.
All that talk about high quality ad nauseum, wide moat, oligopolies, the big get bigger.
Yeah, so participation's still in the narrow range.
Yeah, so the big bank kicked it off, and they all beat expectations, which is good.
Mm-hmm.
Largely on trading and investment banking. Net interest income was kind of the sore spot, and what that is reflecting is higher funding costs. So they're paying more for deposits and also lower loan balances.
Okay.
So the big banks are fine. We're seeing pressure now. We just got earnings from PNC and U.S. Bank, and they're more affected by commercial real estate. They're more affected by the consumer, and their net interest income was down a bit more, and those stocks have been dropping. So bifurcation within banking.
Mm-hmm.
Next week, we get Google and Microsoft, and then the following week, we'll get Apple and Amazon.
So what are the big questions now in regards to earnings?
So I think the three big questions we have this quarter will be, one is, how is the consumer doing?
Okay.
So we got a little bit of that from the big banks, through the credit cards and loans that they have. But it's important to understand that the average credit score for a Chase credit card, the big bank credit card, is about 780. So well above the normal rate. So we're going to learn a lot more about the consumer on the banking side once we get more into the regional firms.
But overall, the consumer's been pretty strong. You and I have seen a lot of the evidence. I think the average person can see it. Now, if you take the 40% at the bottom, you got the McDonald's, the Wendy's, all chasing them for, pricing 3 burgers, 4 burgers, whatever it may be. But for the top 60%, they're out there in restaurant spending. We're here in City Center. It is full consistently. People are in and out of shops. People are traveling. Are you seeing any other evidence as far as the consumer right now keeping it strong?
Yeah, so Delta came out with earnings.
Okay.
And they beat expectations, and they commented they keep reconfiguring their cabin to come up with more premium features at a higher price, and they're consistently able to get the price that they want.
Yeah,
and they're booked. Right, that's right. So particularly the higher end consumer is doing very well. Larger companies doing very well. The second thing we'll want to know is, can those big 10 companies deliver that earnings?
Yeah,
that level of earnings growth. The market is largely dependent on that. And then the third thing will be this AI phenomenon. Does that continue to spread? And now with kind of more of an acceptance that AI is going to be part of our life going forward, well, then how are you going to power that?
Yeah.
So energy and some of the industrial metals now and some of the other, infrastructure type
data centers, all this stuff is
exactly.
The chips are going to be a big deal. Well, you mentioned the consumer staying strong. And keeping in mind, to change the sentiment of consumer is not just one dimensional. It takes quite a bit. So that's, I think, a pretty strong thing for many to consider. But the one thing right now that, we keep thinking is challenging the consumer, and it's my next question, is the inflation front, right? You would think higher inflation, we see it's kind of been sustainable. We kind of have another wave coming, but the consumer is still powering through it. But what do you see for inflation? What are some key points there?
So as Jamie Dimon illustrated here recently, we are in a multipolar world, and that supports a higher level of inflation.
Mm-hmm.
We also have, according to the OMB, 5% plus deficit spending going on for the next 10 years. That is a big tailwind.
Yes.
I would throw in, more from a personal standpoint, I still believe there is a structural supply deficit in both energy and the industrial metals that all cumulatively support a higher level
Interest rates.
inflation than the Fed's target of 2%. Based on the last presser and recent comments, he says 2%. He's willing to accept it.
Oh, absolutely. They're trying to find their way to finagle that in there somehow. Plus, I think you and I have talked about it, but I just think their metrics for inflation aren't the best used metrics. They're looking at backward-looking data. I don't think they're looking at some of the forward-looking data out there as far as inflation's concerned.
You know, it frustrates me. We have an investment process, and we have a lot of serious guys here that talk about investment process. And here's how we do things. Here's how we look at things. And I don't really get that sense from when I hear the Fed members talk. Well, data dependent. They largely, as we talked about for a long time, follow the bond market.
Yes.
And when things hit the fan, then they just create a massive amount of liquidity. Yes.
Well, right now it looks like consumer not really concerned about inflation. We've talked about inflation comes in waves. And Kevin, kind of the last big one, but it is the 800-pound gorilla in the room right now, is geopolitical. I mean, we know that this Israeli-Hamas is definitely taking a different turn. Now we've got Iran over the past week is now involved. What would you say for those that are concerned about geopolitical events as far as their portfolios? What is some advice you would give?
Well, as we talked about before, the number one thing to do, I think, to reduce anxiety in this type of environment, lots of uncertainty, is to review and update your financial plans.
Agreed.
Asset values have increased quite a bit, so have expenses.
Yes.
So get that up to date and see your risk tolerance, and then take a look at the portfolio. How does that compare? Is it congruent with your financial plan? Do you have low quality, less liquid, speculative type investments? And what magnitude? And those should be reviewed. But my suspicion is that it's impossible to forecast what's going to happen.
Exactly.
More money would likely be lost trying to trade geopolitical event risk.
Agreed.
Than just focusing on consistent investments that match your financial plan, are of high quality, liquid, and with a long-term focus.
Know your downside.
You're not emotional.
Yeah. Well, and that's the key. And that's the one thing out there that makes people emotional is when geopolitical comes into concerns. People make decisions. I've heard, hey, should I go all to cash or should I do this? The one big thing is that we've seen throughout history, it's shown us geopolitical risk can come and hit the marks to the downside and immediately reverse it. It's not something you can time. So back to what you said, Kevin, I think great advice. Know your downside, look at your financial plan, engage it from there, and that's the best way to play it. Well, Kevin, thanks for joining again, and look forward to seeing you here next quarter.